Welcome to Cash Flow Lab, the podcast where we break down money, markets, and economic moves that affect your financial future. Today, we are undertaking a deep dive into, well, a subject that really underpins global finance. The decades-long dominance of the U.S. dollar. I mean, for the last 80 years, the dollar has enjoyed this unique global status, famously dubbed the exorbitant privilege.
That's right.
It's the undisputed king of global commerce, setting the price of oil and indirectly influencing the interest rate on your mortgage.
Absolutely critical.
But right now in 2025, that dominance is, well, it's under intense scrutiny. We're seeing real geopolitical challenges rising from the BRICS economic bloc, for example.
Yeah, definitely seeing some pushback there.
And competitive currencies like the yuan and the euro are pushing forward, and perhaps most critically, real domestic instability from mounting national debt to kind of political policy whiplash is rearing its head.
That domestic angle is hugely important. Can't ignore it.
So the central question we are tackling today is the U.S. dollar truly losing its global dominance, or is this just, the latest cycle of anxiety? Our mission is to unpack the source material you've shared, cutting through the most, let's say, anxiety-inducing headlines to understand the true state of play.
Okay.
We're going to examine these external geopolitical challenges right alongside internal U.S. domestic policy fears to determine if the dollar is facing an imminent threat or maybe just an inevitable slow evolution toward a different kind of global system.
A big task.
Yeah, we're going to distill these complex economic shifts so you can walk away well-informed, understanding what's really happening beneath the headlines and how this shift or lack thereof impacts your long-term savings and financial future. Okay, let's unpack this enormous question.
It's an enormous question indeed, and that phrase you mentioned, the exorbitant privilege, really is the key. I mean, to talk about the dollar losing its status, we first have to fully appreciate the sheer magnitude of the advantage the U.S. has enjoyed.
Right.
It's not just about a currency. It's about a structural, economic, and geopolitical advantage the U.S. has held since the end of the Second World War. We have to start with the status quo. I mean, since the 1940s, the U.S. dollar has been the undisputed global reserve currency. It drives international trade and fundamentally reinforces the U.S. as the world's leading economic superpower.
Okay, so define reserve currency simply for us. What does that actually mean in practice?
Well, simply put, it means central banks around the world rely on it. They hold massive stockpiles of dollars, overwhelmingly in the form of U.S. Treasury securities, government debt, basically. And they use these reserves to stabilize their own economies, manage their national debt, and implement their trade policies. Historically, the dollar has just been universally seen as the single most reliable, the ultimate safe investment.
And that status didn't just appear out of thin air, right? It wasn't an accident. It was a consciously constructed system built following, the economic upheaval of the Depression and two world wars. What were the foundational moments that really cemented the dollar's place in the global financial hierarchy?
Yeah, it's a story with deep roots. We can trace the setup back to the 1930s, actually. President Franklin D. Roosevelt took critical steps then to centralize U.S. gold reserves.
Okay.
By tying the dollar to a fixed supply of gold, the U.S. dollar was given this foundational credibility and stability that, frankly, many other currencies lacked in that turbulent interwar period. But the truly defining moment, the one we always come back to, was 1944, Bretton Woods. The Bretton Woods Agreement.
Right, the big one.
The U.S. emerging from WWII as really the only major power whose industrial base was intact, and crucially, holding the vast majority of the world's gold reserves at that point. Well, it spearheaded this international monetary agreement.
And what did Bretton Woods structurally achieve? What did it actually set up?
It established a system where international currencies were pegged to the dollar, and the dollar, in turn, was convertible into gold at a fixed price. So $35 an ounce, I believe. This made the dollar the ultimate anchor of the entire post-war financial system. And in that same sweep, it led to the creation of the International Monetary Fund, the IMF, and the World Bank.
Right. Institutions we still hear about constantly.
Exactly. Institutions designed specifically to manage and enforce this new dollar-centric global order. This is really the moment where the U.S. currency became the central pillar of global stability.
And that stability came with a massive unilateral benefit for the U.S., which is where that famous term exorbitant privilege comes from.
Precisely. By the 1960s, this unique status provided such vast kind of one-sided benefits to the U.S. that the former French Minister of Finance, Valéry Giscard d'Estaing, coined the phrase. Think about the practical benefits. The U.S. could essentially print the world's money. It could borrow at dramatically lower interest rates than anyone else because the world needed dollars to function, to trade, to hold reserves.
So it meant the U.S. could finance persistent trade deficits, importing real goods and services from abroad, and essentially pay for them with IOUs, with dollars, that the exporting country then had little choice but to hold as a reserve currency.
That's the key mechanism. You nailed it. Other countries, if they run large deficits, they see their currency depreciate. They face serious inflationary pressure, maybe even a currency crisis. The U.S., because the world needs its currency, is largely shielded from that traditional pressure. It allows the U.S. government and American consumers to borrow cheaply and fund consumption and government spending with relative ease, much more easily than other nations.
Okay, then fast forward to 1971, the Nixon shock. President Richard Nixon completely severs the dollar's final tie to gold, allowing it to float freely. That sounds like a huge gamble.
It was.
You'd think cutting the gold link would destroy the whole system, yet the dollar maintained its status. How? What allowed that resilience?
It was really a testament to the sheer depth and dynamism of the U.S. economy at the time. Despite the massive psychological shift of moving off gold, and it was a shock, the U.S. economy remained incredibly dynamic, productive, and, importantly, seen as reliable.
Okay.
This is a period of sustained growth in U.S. manufacturing prowess and the burgeoning information sector, the dawn of the tech age in some ways. Global trust shifted. It went from the dollar being convertible into gold to the dollar being backed by the full faith and credit of the most powerful, dynamic, and, crucially, rule of law governed economy in the world.
So trust shifted from gold to the U.S. economy itself.
Exactly.
Yeah.
And its dominance has mostly only strengthened since then, even as competitors like Europe and Japan and later China have grown significantly.
So if the dollar isn't pegged to anything physical anymore, and other economies have obviously grown enormously since the 70s, what is the true power mechanism today? How deep is this financial embedment across the globe now?
Oh, the embedment is profound. And it goes far beyond just, say, trade between the U.S. and China or the U.S. and Europe. International trade that doesn't directly involve the U.S. often still requires the use of the dollar as an intermediary.
Really?
Yeah. Our sources, citing experts like Rachel Ziemba from the Center for a New American Security, illustrate this perfectly with transactions between emerging markets.
Give us an example.
Okay. For example, if a company in Brazil wants to buy something from a company in South Africa, they're dealing in the Brazilian real and the South African rand.
Right. Two different currencies.
But often the trade settlement between them isn't done directly, real to rand. Instead, the Brazilian real is converted into U.S. dollars first, and then the U.S. dollars are converted into South African rand to complete the purchase. That transaction, even though it started and ended completely outside the U.S., used the dollar as a necessary intermediate currency. It happened in dollars.
Wow. So even without the U.S. being a direct trade partner, the dollar is still acting as the default, almost mandatory intermediate currency. It owns the financial rails, so to speak.
Precisely. It owns the rails. And this grants the U.S. what is called extraterritorial power.
Okay, extraterritorial power. What does that mean in practice?
It means U.S. law and regulations can reach beyond U.S. borders. This flexibility is the source of the U.S.'s ability to, quote, weaponize its currency via financial sanctions.
Right, the sanctions tool.
Exactly. Since those real-to-rand transactions often pass through U.S. dollar-based correspondent banks, or maybe use U.S. financial clearing systems that are subject to U.S. law, well, they can be subject to U.S. sanctions and regulation, even if the U.S. is not a direct party to the trade itself.
That is the ultimate geopolitical leverage.
It really is.
It fundamentally makes the dollar less about just being a currency and more about being geopolitical infrastructure. Like you said, the U.S. owns the toll roads of global finance. And if a country gets on the wrong side of the U.S., they can just flip a switch and shut down the road to that country's economy.
That's a good analogy. It's a staggering amount of influence, truly.
Okay, that structural power is clear. But let's pivot now to the current friction points. Because that geopolitical tool, that sanctioning power, is precisely what seems to be driving a lot of the pushback we're seeing in 2025.
Absolutely.
We've got these external geopolitical threats and also internal domestic instability brewing. Let's start with the geopolitical challenge, these de-dollarization efforts.
Yeah, the de-dollarization efforts are definitely accelerating, and it seems to be in direct response to that weaponization of the dollar you just mentioned. The BRICS economic bloc, that's Brazil, Russia, India, China, and South Africa,
Mm-hmm.
has actively sought to reduce its reliance on the dollar in recent years.
Why? What's their main motivation?
Primarily, they view that reliance as an unacceptable vulnerability. I
Hmm.
saw what happened to Russia, for example.
Right.
And leading that charge, of course, is China. They're actively promoting their own currency, the yuan or renminbi, as an alternative.
How are they doing that? What are the tactics?
Yes, China is being quite relentless. They are pushing de-dollarization through aggressive trade tactics, like pricing oil contracts in yuan, and critically, by forming bilateral currency swap agreements with other countries.
Yeah.
This is a key technical detail we probably need to understand a bit better.
Okay, yeah, let's define that for the listener. What does a currency swap agreement actually achieve, practically speaking? How does it bypass the dollar?
Okay, so a currency swap agreement is essentially a bilateral deal between two central banks, let's say China and Brazil, for example.
Okay.
They agree to exchange large amounts of their own currencies, yuan and real, at a predetermined exchange rate, usually for a set period. This allows businesses in China and Brazil to settle trade between their two nations directly in yuan and real.
Ah, so it cuts out the middleman.
Exactly. It completely bypasses the US dollar as the intermediary currency for that specific trade flow.
What are the benefits for them?
Well, first, it saves them from paying the transaction fees associated with the dollar-based settlement system. But more importantly, it shields that trade flow from the jurisdiction of U.S. financial regulations and, crucially, potential U.S. sanctions.
I see.
It's a targeted effort to build an alternative financial plumbing system. And while the volume going through these swaps is still relatively small compared to the dollar's massive global volume, it represents a concrete strategic threat to the dollar's role as the go-to intermediate currency.
So China is essentially trying to build enough of these bilateral pipes, these alternative routes, to slowly drain some of the water out of the dollar's massive global pool.
That's a fair way to put it. Build parallel systems.
And it's not just competitors like China pushing back, right? Even traditional allies are expressing caution or looking to boost their own currencies. The euro seems to be trying to capitalize on this uncertainty.
Absolutely. You had European Central Bank President Christine Lagarde noting recently that a clear shift is underway. She actually framed this moment as a major opportunity for Europe, calling it, I believe, a global euro moment.
A global euro moment? That's quite ambitious.
It is ambitious. She wasn't suggesting the euro would replace the dollar overnight, not at all, but rather that the current perceived instability or uncertainty around the U.S. allows the euro to grow its share of global reserves and trade settlement.
She cited specific data too, didn't she? Something about reserve shares.
Yes, she noted that the euro currently accounts for approximately 20% of global foreign exchange reserves, which is significant, number two, globally. But it's still, compared to the dollar's, still dominant 58%.
So still a huge gap.
A massive lead for the dollar, yes. But Lagarde's quote, something like the dominant role of the U.S. dollar is no longer certain, really drives home this feeling of vulnerability, or at least questioning. The regime seems totally enduring until you start seeing these cracks appear, you know?
Yeah. And geopolitical push is one thing, but that push is made far more effective when it's coupled with domestic U.S. instability, right?
And as a critical connection, absolutely. Let's look at that domestic picture now, because it's arguably just as important, maybe more so in the long run.
Okay. Our source material points out that the dollar has recently weakened quite a bit. It experienced its sharpest six-month decline in decades at one point, largely because global investors seem to be reacting not just to economic fundamentals, but specifically to policy uncertainty coming out of the U.S.
That reliability factor is the dollar's single biggest asset, perhaps, and policy uncertainty chips away at it relentlessly. We sometimes call this phenomenon policy whiplash.
Policy whiplash, meaning?
Repeated, abrupt policy reversals from one U.S. administration to the next. This severely undermines the predictability and reliability that foreign nations and international investors require for any kind of long-term planning or investment.
Can you give an example? What kind of policies cause this scarring and pain, as one of our sources put it?
Well, think about shifts in trade policy, specifically tariffs. One administration imposes sweeping tariffs, maybe even on allies, disrupting long-standing supply chains, forcing companies to reorganize, demanding new contracts be written.
Right.
Then the next administration comes in and abruptly reverses or significantly modifies those tariffs. Or think about sudden withdrawals from international agreements like the Paris Climate Accord or the Iran nuclear deal, and then maybe attempts to rejoin later.
Okay.
That constant shift, the U-turn on major international commitments, makes it incredibly difficult for other nations, other companies, to formulate long-term strategies that rely on the U.S. as a stable, predictable partner.
Yeah, Alex Jacques, who was a special assistant to the president, highlighted that exact point. He talked about the scarring and pain felt by international partners during previous policy shifts, noting that regaining that lost trust is immensely difficult because it becomes a pattern of perceived unreliability.
And that political instability is dramatically compounded by fiscal fears. The recently signed tax legislation, for instance, is projected to add, an eye-watering $3.4 trillion to the federal deficit over the next decade.
Wow, that's a huge number.
It is, and that kind of rapid debt accumulation stokes severe long-term fears about U.S. economic stability. If the supply of supposedly safe U.S. debt assets treasuries keeps flooding the market at that pace, it could eventually raise borrowing costs globally and directly erode the dollar's traditional safe haven appeal. People might start asking, is this really the safest place for my money?
Which brings us to perhaps the most delicate topic of domestic stability, the Federal Reserve. Any concern over attempts to influence the Fed's independence is a major red flag to global markets, isn't it? Because the Fed is supposed to be the non-political guarantor of U.S. financial stability.
It is the bedrock, the ultimate check on the system, meant to be independent of short-term political pressures. Yet we've seen immense political pressure exerted. President Trump, for example, repeatedly criticized Chairman Jerome Powell for not lowering interest rates faster or further.
Right, and there was talk of replacing him or even firing him.
Exactly. Even though Trump later walked that specific threat back, calling it highly unlikely, the damage might have been done. Reports indicated the White House began the formal process of vetting potential successors for Powell, even though his current term doesn't end until 2026. That alone sends a clear and frankly chilling message to global financial markets about potential politicization.
So the threat itself, the mere discussion of potentially compromising the Fed's independence, is what creates the instability, regardless of whether it actually happens.
Absolutely. Michael Pierce, who's a deputy chief economist at Oxford Economics, pointed this out very clearly in our sources. He said that policies that threaten the Fed's independence policies, that would introduce political risk and make investing in U.S. Treasuries seem potentially unreliable or subject to political whim, are the key concern regarding the potential loss of reserve currency status.
Why is that the key concern?
Because if global central banks, the biggest holders of dollars, cannot rely on U.S. Treasury bonds being the safest, most politically independent asset to hold their nation's savings in, the entire stability argument for the dollar starts to collapse. These domestic political issues, these perceived instabilities, they hand geopolitical competitors like the BRICS, block the perfect political ammunition to make their case for alternatives. Okay, so despite all that, the very real geopolitical pushback and the, let's call it domestic drama, we have to inject a dose of sobering reality into this conversation because the overwhelming expert consensus on the speed of any potential shift is pretty firm.
Okay, and what is that consensus?
It is definitely premature to worry about the dollar losing its status anytime soon, like really soon.
So all the headlines we see sometimes suggesting the dollar is on the verge of imminent collapse, you're saying that's greatly exaggerated.
They are almost entirely overblown, according to most serious analysts. Even if a fundamental shift does occur, experts generally agree it would take multiple years, probably decades, think 20, 30, or maybe even 50 years, to fully unwind the dollar's position.
Decades, not years.
Decades. Pierce, the economist we just mentioned, put it quite clearly. A dramatic shift where the U.S. completely loses its place at the top of the financial pile is far off the cards. And crucially, there is currently no viable contender emerging that could fully replace the dollar across all its different functions: reserve currency, trade currency, invoicing currency, etc.
Okay, but why does it take so long? I understand inertia is powerful in finance, but if countries are actively seeking alternatives, like you said with the BRICS, why can't they just shift more quickly? What's stopping them?
It's the sheer complexity and the incredible depth of the existing financial plumbing. The dollar isn't just a currency used for trade between countries. It's the universal medium for almost everything else in global finance.
Like what?
Well, think about the derivatives, markets, futures, options, swaps. These are markets worth trillions upon trillions of dollars, and they're almost entirely denominated and settled in U.S. dollars. Think about global clearinghouses for financial transactions, international insurance policies, even invoices for shipping containers crossing the ocean. The default currency for all of this is overwhelmingly the US dollar. To replace the dollar, other countries or blocks of countries would have to essentially rebuild this entire global financial infrastructure from the ground up in a different currency. And that requires enormous amounts of time, massive international coordination, and perhaps most importantly, deep, abiding trust in the legal stability and predictability of the alternative system.
So the infrastructure itself is just too vast, and the connections are too deep, too embedded to be unwound quickly or easily.
Exactly. It's like trying to change the gauge of every railroad track in the world simultaneously. It's a monumental undertaking.
So if outright replacement isn't really the path, what is the most likely scenario moving forward for global finance? What do the experts see happening?
The consensus really points toward a transition, not to replacement, but to what's being called a multipolar currency system.
Multipolar, meaning multiple currencies share the load.
Precisely. The dollar would certainly remain primary, probably for a very long time, but it would gradually share its global reserve role and its role in trade settlement with other major currencies. Most notably, that would likely be China's renminbi, especially regionally, and the euro.
Okay.
Rachel Zamba, the expert we mentioned earlier, noted that we are heading into an environment where there is, quote, a necessity for an additional role for other currencies. It's not about finding one single clear alternate currency to take over, but more about establishing a system with several regional or functional reserve assets operating alongside the dollar.
I see. A more diversified portfolio of reserve currencies, perhaps, but even a managed transition to that kind of multipolar system, even if it seems inevitable eventually, that must require immense time and global coordination, right?
Absolutely.
And I imagine China's currency, the yuan, still has significant hurdles to overcome before it can truly share the global throne with the dollar, even in a multipolar world.
Oh, massive hurdles. The primary reason the yuan isn't a viable global replacement, or even a full co-equal right now, is twofold. A lack of financial market depth and, critically, a persistent lack of trust.
Explain that lack of trust issue.
Well, the dollar's strength relies heavily on the U.S. having, generally speaking, transparent markets, a very deep and liquid treasury market where anyone can buy and sell easily, and operating under a predictable rule of law that, in theory, protects foreign capital.
Okay.
The yuan, on the other hand, suffers from extensive Chinese government capital controls. These are rules that restrict how easily foreigners can move their money in and, more importantly, out of China.
Ah, so you might be able to buy yuan, but getting your money back out might be difficult or subject to government approval.
Exactly. And no central bank is going to bet the stability of its entire national economy, its reserves, on a currency where the government can arbitrarily lock down assets or restrict fund movement based on political decisions. That's why, as Alex Schock has noted in our source material, you would need a managed unwinding through either coordination or kind of some sort of alternative system to emerge, which, again, would take time. Trust takes decades to build.
Okay, let's put the recent decline in the dollar's share of reserves in context using data. Because often the data tells a less dramatic story than the headlines, right? How much has the dollar share actually slipped, and is it unprecedented?
Yeah, it's crucial to contextualize this. Data from JP Chase, cited in our sources, shows that while the dollar's share of global reserves has declined recently, it's currently just under 60%. This is not unprecedented territory at all.
Really? It's been lower before.
Yes. The dollar share in foreign exchange reserves was actually lower than it is today back in the early 1990s.
Why was that?
Mainly due to the rise of the German Deutschmark before the euro and the Japanese yen, which were seen as strong alternatives at the time. The system has always evolved. Shares shift.
Okay.
Furthermore, if you specifically look at emerging markets, the BRICS countries and others, the ratio of U.S. dollar reserves they hold today is roughly the same as it was back in 1995.
Wow. So despite all the talk, their actual holdings haven't shifted that much structurally over the long term.
On aggregate, not as dramatically as the rhetoric might suggest. This suggests that while anxiety is high and diversification efforts are real, the underlying structural factors holding the dollar in place, its liquidity, the depth of U.S. markets, its use in trade, are still overwhelmingly powerful. At the end of the day, stability and liquidity often win out for reserve managers.
And that speaks directly to investor inertia, doesn't it? Countries hold U.S. treasuries primarily because they are the most liquid assets in the world, easy to buy, easy to sell quickly if needed, and they provide stability to their own domestic currencies and economies. They rely on the sheer scale and reliability of the U.S. market.
Absolutely. And here's where inertia becomes sort of self-reinforcing. Large-scale, sudden selling of U.S. assets by major holders like China or Japan is actually unlikely. Why? Because unraveling the dollar's status too quickly could seriously undermine the value of the massive dollar reserves they already hold. It could hurt their own interests significantly.
So that they have an incentive not to rock the boat too much too quickly.
Exactly. JP Morgan's analysis projected something quite interesting. They noted that because more than 30% of foreign-held treasury bonds are set to mature, just naturally come due within the next 2 years.
Okay.
International investors are more likely to simply let those assets mature quietly and then make a conscious decision to reinvest part of the proceeds elsewhere, maybe into euro bonds or something else. It's likely to be a slow, gradual drain or diversification at the margins, not a sudden, dramatic flood out of the dollar.
Okay, that makes sense. It's a slow, managed adjustment rather than a panic, which brings us full circle really to that ultimate double-edged sword we talked about. Sanctions. The U.S.'s extraterritorial power, its ability to weaponize the dollar, is what gives it this massive influence. But that very power is the primary engine compelling other countries, even allies sometimes, to actively seek alternatives.
It is the ultimate paradox of dollar dominance. The short-term exercise of its power potentially fuels its long-term erosion. The U.S.-led sanctions on Russia in 2022 after the invasion of Ukraine are the clearest recent case study of this.
How so?
Well, those sanctions were incredibly effective from a U.S. policy perspective. They largely cut Russia off from dollar-based international trade. They allowed the freezing of around $300 billion in Russian central bank assets held abroad. And they contributed to a sharp, painful $104 billion drop in Russia's GDP that year.
So that demonstrated the dollar's incredible power to project U.S. foreign policy objectives, to punish adversaries.
Yes, absolutely. But simultaneously, it sent a powerful and undeniable message to every other country in the world, friend or foe. Complete reliance on the dollar system means complete vulnerability to U.S. foreign policy decisions, regardless of whether you agree with those decisions or whether they even involve you directly.
Right. If they can do it to Russia, they could potentially do it to us under certain circumstances.
That's the fear. That is the core geopolitical incentive for de-dollarization, that no amount of pure economic stability or market liquidity can fully counteract in the very long run. The pace may be slow, as we've discussed, but the direction of seeking alternatives, motivated by the fear of weaponization, seems pretty well established now.
Okay, let's make this really tangible for the listener. This entire discussion on central bank reserves, geopolitical blocks, currency swaps can all feel pretty abstract. But if the dollar were to truly lose its exorbitant privilege, what would that mean? The impact on everyday domestic life in the U.S. would be profound and immediate, wouldn't it? How significant are the stakes?
Oh, the stakes couldn't be higher. It's not an exaggeration. As former President Trump rightly stated, and it's a rare point of agreement across the political spectrum, sometimes losing the world standard dollar would be like losing a war. We would not be the same country.
Wow. Like losing a war. Why is it that dramatic?
Because the U.S. would fundamentally lose its unique leverage to influence global trade patterns, its power to effectively enforce sanctions, and, perhaps most importantly for domestic life, its ability to manage its own economy through uniquely cheap debt.
Okay, let's focus on that last point. The most direct domestic economic impact that hits everyone's wallet would presumably be higher borrowing costs, right? Explain that mechanism for us. How does losing reserve status lead to higher mortgages?
Absolutely. That's the most direct link. Remember, the privilege means the U.S. has this guaranteed massive access to what economists call a big pool of foreign savings.
Yeah.
All those central banks and investors around the world who have to buy U.S. debt.
Right? They park their reserves in treasuries.
Exactly. That constant demand keeps the interest rates, the yields on U.S. Treasury bonds artificially low compared to where they might otherwise be. Now, if the dollar status seriously erodes, if foreign central banks and investors start holding significantly fewer U.S. Treasuries, maybe shifting to euro bonds or gold or something else,
Demand for U.S. debt drops.
demand drops. To attract buyers for all the debt the U.S. government issues, the Treasury Department would have to offer much higher interest rates, higher yields, to entice the remaining domestic or international buyers.
Okay, so the government's borrowing costs go up. But how does that translate to my mortgage or credit card?
Because those higher Treasury yields don't stay siloed in government finance. They become the benchmark, the base rate, for all long-term domestic lending in the U.S.
Ah, I see.
Every private bank in the U.S. pegs its long-term interest rates, the rates they charge for 30-year mortgages, for 5-year auto loans, for business lines of credit, even variable rates on credit cards eventually. They're all heavily influenced by the Federal Reserve's policy rate and, crucially, the prevailing yield on U.S. Treasuries.
So if Treasury yields rise because global demand has dropped, the cost of borrowing goes up across the board for you, the consumer, and for businesses too.
Immediately and significantly. Mortgages become more expensive, making housing less affordable. Consumer spending could get choked off by rising credit card rates. Business investment slows down because the cost of capital is higher.
So a serious loss of dollar dominance is essentially, as one source put it, a fundamental threat to the U.S. economic model of the past few decades. The model built on relatively low interest rates and easily available cheap debt.
Precisely. It potentially ends the era of relatively cheap debt that has enabled U.S. consumers, firms, and the government itself to finance vast amounts of spending and accumulate significant debt at historically low real prices for much of the last 30, 40 years. It would fundamentally shift the entire foundation of the modern American economy. It's hard to overstate how big a change that would be.
Now, there's a fascinating wrinkle in this, which is the internal U.S. debate about whether the dollar's reserve status is actually a good thing for everyone domestically. It's not universally viewed as purely beneficial, is it?
That's right. It's a really important point. The benefits of the exorbitant privilege are definitely not equally distributed within the U.S. economy. Former Senator, now Vice President J.D. Vance, voiced this specific perspective very clearly. He argued, and others have too, that the reserve currency status acts as a massive subsidy to American consumers, but a massive tax on American producers.
Okay, let's break that down. How is it a subsidy to consumers but a tax on producers? That sounds counterintuitive.
It's fairly simple mechanics, actually. Because the world constantly needs to buy dollars for trade and reserves, this persistent demand keeps the value of the dollar artificially strong on foreign exchange markets compared to what it might otherwise be based purely on trade balances.
Okay, so the dollar is stronger than it should be.
Arguably, yes. A strong dollar makes imports cheaper for U.S. consumers. Your imported clothes, electronics, cars from Germany or Japan, they cost less in dollar terms. That's the subsidy to consumers. You benefit at the checkout.
Got it.
However, that same strong dollar makes U.S. manufactured exports more expensive for foreign buyers. If you're trying to sell American-made machinery or agricultural products overseas, a strong dollar makes your product less competitive against goods priced in weaker currencies. That directly harms the competitive edge of American producers, manufacturers, farmers trying to sell abroad. That's the tax on producers.
So it handicaps manufacturers and exporters who compete globally, while favoring consumers who buy imported goods and the financial sector that facilitates these global flows.
That's the core of the argument, yes. And you see the irony, right? Current U.S. policies, like tariffs, are often supposedly aimed at helping those domestic producers who feel disadvantaged by global trade. Yet the fundamental structure of the dollar's reserve status itself, which benefits consumers through lower import prices and allows for massive government borrowing, arguably works against those producers by keeping the dollar strong.
So the two policy goals, helping producers via tariffs and maintaining reserve status, can sometimes seem to work against each other, highlighting this complex internal debate within the U.S.
Exactly. It highlights the trade-offs inherent in this system. But it's important to add, the broad consensus among most economists is that while the cost to certain producers from a strong dollar is real, the loss of the reserve privilege altogether would likely create economic damage so vast through higher interest rates, inflation, financial instability, that the consumer subsidy would vanish anyway. It would likely be replaced by generalized economic pain for almost everyone.
So, while the distribution of benefits is debatable, the overall stability provided by the status quo is seen as preferable to the chaos of losing it.
That's generally the mainstream view, yes. The ultimate threat remains the stability of the dollar status itself, even with its internal contradictions.
Okay, so wrapping this section up, what's the final relevance for the listener? The change may be slow, measured in decades perhaps, but the dynamics are clearly in motion.
Right.
Understanding the dollar's vulnerabilities, the specific pressure points, these geopolitical challenges, coupled with domestic policy instability, it seems crucial for anticipating potential market shifts, future inflation trends, and critically, the cost of capital, the cost of borrowing money in the coming years and decades. This knowledge is really about preparation, isn't it?
I think that's exactly right. It's about understanding the landscape you're navigating. Hashtag outro. Yeah. And that leads us nicely into a final provocative thought for you, the listener, to perhaps mull over. We've established that a fast, total replacement of the dollar seems highly unlikely, and that a gradual shift towards multipolarity is the most probable future.
Mm-hmm.
But we really have to reflect deeply on the trade-offs of the U.S.'s primary tool here.
Right.
The use of sanctions, the weaponization of the currency. If the U.S. continues to aggressively utilize this powerful tool, and at the same time, the domestic political system continues to generate uncertainty, that policy whiplash we talked about,
Yeah.
well, how quickly will that combination accelerate the demand from the BRICS bloc, from Europe, from others, for those alternative systems? Regardless of whether those alternatives are truly ready or perfect contenders today, does the push factor from U.S. actions become overwhelming?
That's a great question. The pace of transition is one thing, but the motivation for transition, the desire to find an alternative, seems directly influenced by U.S. foreign policy choices and domestic stability.
Precisely.
So for your long-term financial planning, for your savings, understanding that slow but potentially steady drift toward a more diversified, multipolar currency world seems crucial for anticipating how markets might behave, how inflation might trend over the next decade or two. The direction seems somewhat set, even if the speed is debatable.
Well said.
Thanks for tuning in to Cashflow Lab. If you found this deep dive helpful, be sure to subscribe and follow the show for more smart takes on money and the markets. See you in the next one.